Okay, so let's start. We want to start this new topic called capital budgeting. So let me introduce it. Now, as a company, you have some funds that you want to invest. I want to assume you have several projects to choose from. Why to choose from? Because you have limited resources. Okay? So you have either to invest the money in project A or you invest the money in project B. We are assuming your resources are not enough to invest in both. So you have to choose either to invest in project A or to invest in project B. So we want to look at what are some of the techniques that as a company you can use to evaluate these projects so that you know where will you invest. Will you invest your funds in project A or will you invest your funds in project B? Now, those techniques that we normally use to evaluate projects are classified into two categories. What we want to discuss now are project evaluation techniques. What are the project evaluation techniques? I have said the techniques that you as a company you can use to evaluate these two projects are classified. Those projects are those techniques or those methods are classified into two categories. One is what we call the first category of techniques or methods is what we call non-cash discounting. Non-cash discounting techniques. Non-cash discounting techniques, that's one of the methods of determining where to invest. Okay? We shall discuss it in details. That is one category of techniques. The second category of techniques is what we call discounting techniques. These are techniques that you can use as a company in evaluating your projects. So you either use the non-cash discounting techniques or you use the cash discounting techniques. Now listen. The non-cash discounting techniques are those techniques that do not take into consideration the time value of money. Those techniques that don't take into consideration the time value of money, we normally classify them as non-cash discounting techniques. We shall look at those methods under that class, but we are saying what are they generally? They are those methods of evaluating projects which do not take time value of money into consideration. The second category of techniques is what we call the discounting techniques. Okay? And under this category, we are saying these are methods or techniques that take into consideration time value of money. When they are evaluating project A and project B, they consider the time value of money of the cash flows in those techniques, in those projects. That means they take into consideration time value of money. Now, let me go back now to the first category, which we are calling the non-cash discounting techniques. Which methods do we have under these techniques? Which method do we have under this category? Under this category, we have two methods of evaluating projects. We have two methods of evaluating the projects. One is what we call the payback period. That is one method you can use to evaluate projects under this category. One is called payback period. The second one is what we call accounting rate of return. Accounting rate of return. That's another method under the non-cash discounting techniques. Okay. Let me list the methods under the second category. Let me first list the method under the second category. That means under the discounting techniques. Under the discounting techniques, I've told you these are techniques that take into consideration time value of money. And under this category, the following are the methods that can be used in evaluating the projects. Following are the methods that can be used in evaluating the projects. One is what we call the discounted payback period. Discounted payback period. That's one method of getting or to evaluate a project. Number two, another method is what we call the net present value. Net present value method. Net present value. We also call it NPV in short. NPV. NPV. That's another method you can use. Another method we can use is what we call profitability index. Profitability index. Profitability index as another method of evaluating projects. This, in short, we normally call it as PI. The other method you can use is what we call internal, number 4, internal rates of return. Internal rate of return. In short, we normally call it IRR. That is another method you can use under this category. Number 5 is what we call modified rate of return. Sorry, modified internal rate of return. Modified internal rates of return. Modified internal rate of return. We also call it in short MIRR. Good. So these are the various methods under the discounting techniques. I've said they are those methods that take into consideration time value of money. Okay. Let me go back now to the first method. Let me now go to the first method or the first category where we have said the two methods that do not take into consideration time value of money. The first one we have said is called the payback period. So let me discuss this first method, payback period. How do we use it to evaluate the two projects or whichever projects you have? Whichever projects you have, how do you use them? Now, let me introduce it by using an illustration first. Let me illustrate by using an illustration. As a company, you have 20 million shillings you want to invest. We said you have to invest the 20 million either in project A or you can invest it in project B. You choose one of the two projects. But if you choose project A, that project A will be giving you how much? Maybe 5 million shillings every year. That is what we call the annual cash inflow. The annual cash inflow from project A will be 5 million every year. So if I invest 20 million shillings today, and from this project, I'll be recovering 5 million every year. 5 million every year. The question now is, how many years will it take me to recover my initial investment? This 20 million is what we are calling the initial investment. How many years would it take you to recover your initial investment? That number of years it will take you to recover your initial investment is what we are calling the payback period. So payback period is the number of years it will take you to recover the initial investment. And I hope from here you can easily tell how long it will take. Are you able to tell? Are you able to tell how long it will take? If I invest 20 million today, and this project will be giving me back 5 million, 5 million, 5 million, a constant amount of 5 million, then it will take me how many years? Obvious, I want to believe you are able to get it. It will take me only 4 years to recover my 20 million. Okay? It will take me 4 years to recover my 20 million. So how are we getting the 4 years? It is the payback period equals to, we take the initial investment, we take that initial investment, which is your 20 million, you divide that by the annual cash inflow. You divide that by the annual cash inflow, which from this illustration, it will be 20 million divide that by 5 million, that will take you 4 years. Good. So that is what project A, that is the payback period of project A. Let us assume that instead of investing in project A, you could invest it in project B, which again has an initial cash has an initial cost of 20 million. But for this project B, it will be giving you an annual cash inflow. Annual cash inflow, this is annual cash inflow, let's say of 10 million every year. It will be giving you 10 million every year. It will be giving you 10 million every year. So how many years will it take you to recover your 20 million if you invest it in project B? It will be 20 million, divide that by 10 million, that will take me 2 years to recover my investment. The question now comes, as a company or as an investor, would you invest your 20 million in project A, or would you invest your 20 million in project B? Where would you invest this 20 million? It is obvious, listen, it is obvious you will invest your money or your 20 million in project B. Why? Because it has a shorter payback period. You tend to recover your 20 million faster in project A than in project B, you tend to recover your 20 million faster in project B than in project A. And so we normally say, listen, when you're evaluating the project using payback period, we normally say the shorter the period, the better. The shorter the period, the better. Why? Because the less the risk the project is. Project B, we normally say, is less risky than project A. Remember, we don't know about the future. So the faster I'm able to recover my investment, the better for me because of the uncertainty in the future. So project A will take me 4 years to recover my 20 million. Project B will take me 2 years to recover my 20 million. Okay? And so we are saying the shorter the period, the better. Okay? Good. Now, what if, listen to this now, I'm changing something. What if your project A, yes, cost 20 million, but the following are the cash flows that you will be generating from project A. In year 1, you will recover 5 million. In year 2, let's assume 5 million, that's what you recover. In year 2, you will recover maybe 4 million, or let's assume, 4 million. In year 3, you will recover maybe another 6 million. In year 4, maybe you will recover maybe another 8 million. And in year 5, maybe you recover another 10 million. These are the cash flows that will be generated by the project in those past 5 years. How long will it take you to recover your investment? Where our cash flows are not uniform. First year, I will recover 5 million. Second year, I will recover 4 million or whatever. The other year, I will recover, let us assume it's even increasing. Let me put it here, maybe 4, 5. Okay? Good. So how long will it take you? Where we have uniform cash flow. That is the discussion I want to bring in up now. How do you evaluate a project where the cash flows are ununiform? Now, what you do when you have ununiform cash inflows, you use what we call the cumulative method. So what you will do, you will cumulate your cash inflows. You will cumulate them. At the end of year 1, you will have recovered 4 million. By end of year 2, you will have now recovered plus another 5 million, which comes to be how much? 9. By end of year 3, you will have recovered another 6 million. So cumulatively, you would have recovered 15. In the third year or fourth year, you recover another 8. So cumulatively, you would have recovered 23. Okay? Then in the fourth year or fifth year, cumulatively now the cash inflow cumulative will be 33. Okay, now listen. So this is how you will recover your investments cumulatively. Now, then you identify between which year and which year will I recover my 20 million. You identify between which year will I recover cumulative using the cumulative column. It is obvious, therefore, if the initial investment was 20 million, it is obvious I'm going to recover my investment between the third year and the fourth year. That is what we are saying. This is where the initial cost lies. The initial cost of 20 million lies there cumulatively. Okay? So that means your year of recovery is between year 3 and year 4. So it will obviously be 3 years and some months. That is your recovery period, or the payback period will be 3 years plus some months. That's meaning we need to determine those extra months. Is it 2 months, 3 months? That's what I want to talk about now. But we have seen the year before full recovery is the third year. Third year, by end of third year, I would have recovered 15. By end of fourth year, I would have recovered 23. So the year before full recovery is what we are starting with, which is third year. So we are taking now payback period will be 3 years plus some months. That's what I want to talk about now. It will be 3 years plus some months. Now listen. So you will ask yourself, listen, now by end of third year, I've recovered only 15. What is the balance remaining? What is the balance remaining to be recovered? If the initial cost was 20 and I have so far recovered 15, I have a balance of 5 million to recover. Now listen to the argument. I have a balance of 5 million to recover. If you look at year 4, I'm going to recover 8 million in year 4. So we argue by saying, if 8 million will take me, listen, if 8 million will take me 12 months to recover, 8 million will take me 12 months to recover. But I don't need the whole of 8 million in the fourth year. I only need a balance of 5 million. Don't forget, you have recovered 15 so far. The balance of your investment is 5 to recover the balance. That balance will be recovered in the fourth year. Okay? Then you argue by saying, if in the fourth year, I'm going to recover for 8 million, and it will take me a whole of 12 months to recover my 8, how long will 5 million take me to recover? How long will 5 million take me to recover? It will be 5 times 12. You divide that by 8. You divide that by 8. Now listen. So this fraction now is the one now I want to bring it up here now. To determine the payback period, you take the year before full recovery, which is which year? Third year. Plus, I've indicated there plus 5 times 12, divide that by 8. Now let me explain what is 5. We have said 5 is what? You are remaining with 5 million to recover. By end of year 3, you are remaining with 5 million to recover. So that 5 million is what we call the cash balance to full recovery. You take 3 years, which is the year before full recovery, plus the cash balance before the cash balance to full recovery. The cash balance to full recovery. You divide that by the cash flow of, where is 8 coming from? You take that 8 to be the cash flow of the year in full recovery. The year of full recovery. What is the cash flow of the year to full recovery? Are you there? Once you do that, now you multiply by the number of months. Multiply by the number of months. Or it will be 3 point something years. It doesn't matter. You don't have to multiply by 12. It can be take 3 years point, 5 months, 3.5 years, 3.5 years, and so on. But you can do it in form of months. 3 years and 2 months, 3 years and 4 months. So let's do that calculation. Let me do that calculation here. So we are saying it's 3 plus 5 divided by 8 times 12. So what does it come to? This will be 3 years plus how many months? 3 years plus how many months? Let me do that calculation. That will be 5 times 12. Divide that by 8. That gives me 7.5 months. So in the next 7.5 months of year 4, you will have recovered. So our recovery or our payback period is 3 years and 7.5 months. Okay? But what I want you to understand is the logic. What I want you to understand is the logic, not the cramming. You get the year before full recovery, which was the 3rd year. The year before full recovery was 3rd year. Are you there? Good. Then I've said you add the balance of the cash, to full recovery. You invested 20 million. By end of year 3, you have cumulatively recovered 15. So the balance to full recovery is 5 million. That's what you have taken. Then I've said you divide that by the cash flow. You divide that by the cash flow of the year. The cash flow of the year of full recovery. Our cash flow of the year to full recovery, which is year 4, is 8 million. Then you multiply by 12. I've given you the logic, how we are getting that 7.5 months. I have said, if you had a balance of 5 million to recover, listen, and you are going to recover it in the 4th year, you will argue by saying, if 8 million will be recovered in the 4th year, and that 8 million will take me 12 months to recover, how many months will it take me to recover the balance of 5 million? We are multiplying that by taking 5 times 12, we divide that by 8. 5 times 12, we divide that by 8. I've explained what is 5. I've explained what is 12. I've explained what is 8. 5 is the balance of the cash to full recovery. 8 is the cash flow of the year of full recovery. The cash flow of the year of full recovery. Then 12 is the number of months. 12 is the number of months. Good. So in other words, for this method, where we have no uniform cash flow, the formula therefore would be, the formula therefore for payback period, we are saying is given by year. We can say that would be given by year before. Let me put it clearly so that payback period now, this is payback period. How do you determine it? It will be year before full recovery. Year before full recovery plus. We are saying cash balance to full recovery. Cash balance to full recovery. Then you divide that by cash inflow. Cash inflow in the year of full recovery. Okay. Then I said you multiply everything by what? 12. That is the formula we shall be using in determining the payback period in case you have ununiform cash inflows. Okay. Good. So before we put down an example, listen, before we put down an example to this method, let me talk to a few of you. Some of you are watching this video. Some of you are watching this video and you have not subscribed to my YouTube channel. If you are watching this video and you have not subscribed to my YouTube channel, please subscribe by clicking that subscription button down there. Click that subscription button so that you can be notified whenever we post new videos into the YouTube. Okay, so click that subscription button so that you can be notified whenever we post new videos into YouTube. Okay, point number 2, please click that like button. Click that like button to like my video. I hope by now you have at least understood something. Click that like button to like this class or like the video. Okay, just down there, go and click that like button. Okay, good. Now I'm talking to everybody again. Now I'm talking to everybody. You may have friends who want to do online classes. So tell them that we have online classes for financial reporting. Let me start with the financial management. I don't know what we are doing now. Tell them we have online classes for financial management, which is what we are doing now. We also have online classes for financial reporting of the intermediate. For the intermediate level, we have both financial management of the intermediate and the financial reporting of the intermediate. We also offer online classes for advanced financial reporting of the advanced level. Okay? And we also have financial accounting of the foundation level. We also offer online classes for financial accounting of the foundation level, and that one of ATD1 and ATD2. That of ATD1 and also ATD2. Those are the 4 papers we are offering online classes for. 1, financial management of the intermediate level, financial management of intermediate level. 2, financial reporting of intermediate level. 3, advanced financial reporting of the advanced level. 4, financial accounting of the foundation level, and that of the ATD1 and ATD2. Now listen. If your friends cannot join the live classes, then, for whatever reason, then they can still buy what we call the pre-recorded videos. They can still buy what we call the pre-recorded videos, where they can watch the videos at their own free time, at their own pace. Tell your friends that if they can't join the live classes, then they can buy what we call the pre-recorded videos for any of these 4 subjects, for any of these 4 subjects. Okay, now to reach me, they can call me on this number 0722 65 8875, 0722 65 8875. That's how they can reach me. More information and more details. Okay, good. I think that's all I wanted to mention before we continue now. That's what I wanted to mention before we continue. So let's put down something now on what we have already said. Let's put down something on what we have already said before we put down an example on that payback period. So let's put down the information we have so far discussed. So put down the topic. The topic is capital budgeting. The topic is capital budgeting. Put down the topic, capital budgeting. Capital budgeting. That's our topic. Then you say this. Capital budgeting is the topic. Then you say this. This involves capital budgeting. This involves commitment of funds. This involves commitment of funds in the long-term projects. In the long-term projects of the company. This involves commitment of funds in the long-term projects of the company. In the long-term projects of the company. Then have another subheading, project evaluation techniques. Project evaluation techniques. Project evaluation techniques. Project evaluation techniques. Number one, just copy what I've written. Number one, non-cash discounting techniques. Non-cash discounting techniques. Non-cash discounting techniques. Number two, discounting techniques. Number one, non-cash discounting techniques. Two, discounting techniques. Then below there, have another subheading, non-cash discounting techniques. Non-cash discounting techniques. Non-cash discounting techniques. Then you say this. You want to say something below that. Under the non-cash discounting techniques, we want to say something there. Or you copy those two methods. Non-cash discounting techniques. Sema hivi. These are techniques that do not take time, value of money. These are techniques that do not take time, value of money into consideration. These are techniques that do not take time, value of money into consideration. These are techniques that do not take time, value of money into consideration. Full stop. They include one, payback period. They include, number one, payback period. Number two, accounting rate of return. Accounting rate of return. Accounting rate of return. Then you go have another subheading, discounting techniques. Another subheading, discounting techniques. Discounting techniques. Again, before you copy the 5 methods, I want to say something below that. Another subheading, discounting techniques. Then you say this below that. These techniques take time, value of money into consideration. These techniques take time, value of money into considerations. These techniques take time, value of money into consideration. These techniques take time, value of money into consideration. Into consideration. They include number one, discounted payback period. They include discounted payback period. Number two, net present value, NPV. Net present value, NPV. Number three, profitability index, PI. Profitability index, PI. Number four, internal rate of return, IRR. Internal rate of return, IRR. And number 5, modified internal rate of return. 5, modified internal rate of return, in bracket MIRR. Good. Finish copying those 5 methods. Now we go back and discuss the non-cash discounting one. Finish copying those 5 methods. Okay, I hope I can proceed. I hope I can proceed now. Okay, so if you are through, have another subheading now, payback period. Have another subheading, payback period. Subheading, payback period. Payback period. That's what we want to discuss now. Payback period. Then you say this. Payback period. Payback period. Say this below that. Payback period is the length of time. Payback period is the length of time it takes. Is the length of time it takes to recover the initial investment in a project. Payback period is the length of time it takes to recover the initial investment in a project through the cash flows generated. 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 Then under that, we are still discussing payback period. Under that, andika A. Under that, andika A. Under uniform. Under uniform cash flows. Remember, we said they are either an uniform or uniform. That means constant or non-constant. So have another subheading under uniform cash inflows. Under uniform cash flows. Under uniform cash flows. Then I want to say this before we put down the formula. Under uniform cash flows, sema hivi. Under uniform cash flows. Then you say this. If the project generates uniform cash inflows, then the payback period is determined as follows. If the project generates uniform cash inflows, then the payback period is determined as follows. I think you can now even copy this formula. I don't need to rewrite it again. Just copy this formula where we have said payback period equals to initial investment. You divide that by annual cash inflow. You take the initial cash investment, the initial investment cost, and even call it initial investment cost. Initial investment cost divide that by the annual cash inflow. Then we can have a simple example. Hope you are through with the copying of the formula. That payback period equals to initial investment cost. Divide that by the annual cash inflow. Then you can put down the formula. You can put down a simple example. Let's copy a simple example now. Let me dictate it. Sema hivi. If a project costs shillings 30 million, and the project promises a cash inflow, of shillings 10 million per annum. 10 million per annum. 10 million per annum, calculate the payback period. So this would be payback period is equals to 30 million divided by 10 million. This will be 3 years. That's all we are saying. That is for uniform cash inflow. Finish, we discussed the third one, the second method, where we are saying if you have ununiform or non-uniform cash inflows. Finish. So andika B. under non-uniform. Under non-uniform cash inflows. Under non-uniform cash inflows. Under non-uniform cash inflows. Want to say something there below before we put down the formula again? Finish. Have that number B. Under non-uniform cash inflows. Under non-uniform cash inflows. Then you say this. Under non-uniform cash inflows, continue. Under non-uniform cash inflows, comma, the payback period will be determined or computed. That way, under non-uniform cash inflow, payback period will be computed in cumulative form. Will be computed in cumulative form. Will be computed in cumulative form. Another paragraph. Go on. Another paragraph. This means that the net cash inflow. This means that the net cash inflows are accumulated each year. Are accumulated each year or accumulated each year until the initial investment is recovered. 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 Good. For us to put down the formula, let's use an illustration. Let's use an illustration. Andika example. For us to put down the formula, we need to use an illustration. Andika example. Example. A machine has an initial cost. A machine has an initial cost of shillings 30 million. A machine has an initial cost of shillings 30 million. Full stop. It has the following expected cash flows. It has the following expected cash flows. Let me put down the table. This is cash flows. The figures are in thousands. Year 1, year 2, year 3, and year 4. In year 1, you recover 8 million. Year 2, you recover 10 million. That's what you get as your cash inflow from the project. Year 3, you recover 14 million. Year 4, the cash flow is 15 million. 15 million. Then andika hapo chini, determine the payback period. Determine the payback period. Determine the payback period. Determine the payback period. Good. So before we determine it in a formula form, let's get the cumulative. Let's have another table again. Have a column for the year. Have a column of the cash flows. Then you have a column of accumulated cash flows. Accumulated cash flows. Year 1, year 2, year 3, year 4. Year 1, I recover 8 million. Year 2, 10 million. Year 3, it was 14 million. Year 4, it was 15 million. Now I can accumulate them now. Now I can accumulate them. This will be 8 million. This will be 18 million. This will be 32 million. This will be 47 million. Good. Now we can see the cumulative. So we can tell between each year, are we going to recover our 30 million? So we can identify the year before, full recovery. Our initial investment is here. This is initial cost is somewhere there, which was 30 million. Okay. Now I can quote the formula. Just we have already said. We don't need to discuss more. We have already discussed the formula. Just come and see a payback period. Payback period equals to year before full recovery. Year before full recovery plus cash balance. Cash balance 2. This is cash balance to full recovery. This is cash balance to full recovery. Cash balance to full recovery. Then we divide that by, I told you, divide that by cash flow of the year, or cash flow in the year. We can put it that way. Cash flow in the year of full recovery. Cash flow in the year of full recovery. Then whatever you get, multiply that by 12. So copy that formula now. Copy that formula. Copy that formula. So we have seen from our table, the year before full recovery is second year. Think so? Let me confirm. Yes. Year 2, we are recovering our investment between year 2 and 3. So 2 years or year 2 becomes the year before full recovery. Okay. Come and see here. Payback period equals to 2 years plus. I get the balance. So far, at the end of the second year, we have recovered how much? At the end of year 2, we have recovered 18. Our initial investment was 30 million. So you need another how much? If our initial investment was 30, and by end of year 2, I've only recovered 18, then I need to recover another 12. Another 12 by in year 3. So we come and say balance is 12. If you think you'll forget how we are getting that 12, we are getting it by taking 30 million minus 18 million. 30 million minus 18 million. If you think you'll forget how we are getting it. Then we come and say, divide that by the cash flow of the year in full recovery. Cash flow in the year of full recovery. How much was that cash flow? 14. We divide that by 14,000, multiply that by 12, multiply that by 12. So that gives me how many months? Let me calculate it. 2 years plus. Let me calculate. It is 12,000 times 12. Divide whatever we are getting by 14,000. That gives me something like 10 months. It's 10 point something, but it doesn't make a difference. Let's just call it 10 months. 10 point something. Let's call it 10 point. Or you can even put it 10.2 months. But let's just put it 10 months. Okay? So it will take you 2 years and 10 months. Are you there? I have explained the logic. Maybe if you think you'll forget again how we are getting that logic, I said this. In the third year, you are recovering how much? You are recovering 14. Are you seeing it? In the third year, you are recovering 14. So I said, the logic is, if in the third year, if 14,000 will take me 12 months to recover, how about the 12,000 that I need Therefore, 12,000 will take me how long? That's how we are getting it. 14,000 is what we shall recover in the third year. That 14 will take me 12 months to recover. What will 12,000 that I need take me? How long will it take me? So that's why we are saying it will be 12,000 times 12. You divide that by 14. Are you seeing where the logic came in? Yes. That's what we are saying. That you needed a balance of 12,000 to full recovery. But that 12,000 will come from year 3. And in that third year, you are recovering 14. So 14 will take you a whole year, which is 12 months. What about 12,000? How long will it take you to recover it? So what we are giving proportionately, 10 point something months. Okay? Good. To finish, now I want us to do a past paper question. Now that you have understood the concept of payback period, now I want us to do a past paper question now. Finish. I want to project a question. We do it. Finish copying. I project a question. Finish. We do the payback period. Question from your past paper now. I hope you are through with the copying. Let me project the question. Okay, there it is. There it is. We are doing a question of May 2016. Question number 1B. Number A says, explain the concept or principles of capital budgeting. I will explain that later. We have not covered it yet. Number B is what I'm concerned for now. B says, a firm is considering the following investment projects. You have a column for projects A, B, C, and D. Then you have cash flows in year 0. That is, of course, the initial investment. Year 0. All of the projects have an investment cost of 1 million. But year 1, 2, 3, that's where the cash flows are different. For project A, we are going to get 500,000 in year 1, 500,000 in year 2, and nothing in year 3. For project B, we are going to get that amount of how much? We are going to get an amount of project B. We are getting 0 in year 2, in year 1, sorry. Are you seeing it there? We are getting 0 in year 2, in year 1. Sorry for that. We are getting nothing in year 1. In year 2, we recover 650. Are you seeing it there? In year 2, we recover 650. Then in year 3, we recover another 850 for project number what? For project number B. If you look at project number C, just a minute. Just a minute. It's something I'm doing now. Okay, so we can now continue. If you look at project C, the initial cost is 1 million. Then again in year 1, I recover 300. Year 2, I recover 500. Year 3, we get a cash inflow of 1 million. Year project D, the same. Then you are told the firm's cost of capital is 15% required. Number A, rank the projects using payback period method. Number B, rank the project using the net present value method. Okay. We have not discussed the present value method, net present value method, and that's where the cost of capital will be required. Otherwise, we don't take time value of money into consideration when you are doing payback period. But for present value, that's where we shall consider time value of money. So we need to discount those factors or those cash flows. We need to discount them. That's where the discounting comes in. but we shall discount them at 15%. But we shall do part 2 of that once we discuss the net present value method. For now, my only concern is the projects to be ranked using the payback period. Good. So there are 4 projects. So let's compute the payback periods for each of those 4 projects. Then once we compute the payback periods, we rank them according to that technique. Good. So let's do that question. It is a question that came in May 2016. It's question number 1, B1. Question number 1, B1. Shall do later, B2, when we shall be doing the present value method. But for now, I am only after the payback period. So there are 4 projects. Let's start with project A. Let's determine the payback period for that. Remember, these are ununiform cash flows. These are ununiform cash flows. Good. Let's do that. We come and see a project A. So you need a column for the year. You need a column of the cash flows. You need a column of the cash flows. You need a column of the accumulated cash flows. Let me go and copy the data for project 1 or project A. What are they giving us? Okay, for project A, I can see the year 1. We have year 1, 2, and 3. Year 1 is 500,000. That's the cash flow. Year 2, another 500,000. Year 3, we have nothing. Good. Let's now use that for project A. The cash flows are 500, 500. And in the third year, nothing. Let's cumulate them. This will be 500. This will be 1 million. Okay, this will be 1 million. So our initial investment cost was $1 million. That was the initial cost. You can even quote it here. Initial cost is 1 million. So it's obvious the payback period here will be what? Payback period is obviously 2 years. So that one, there is no problem here. Come and say a payback period. 2 years. It's exactly 2 years. Because we are recovering it exactly by the end of year 2, not affecting year 3. Good. That is not a problem. That's for project A. Finish, we go to project B now. Finish, we go to project B. So let's do the same for project B. So again, we come to cash flows. No, sorry, year. Start with year. Come to cash flows. Then we come to accumulated cash flows. Let's go back to the question and copy the data for year 2. Okay. So we have 3 years, year 1, year 2, year 3. Let me go back to the question. I can see year 1, project A had nothing. I hope you are seeing there. Project A had nothing. No, project B, sorry. Then second year, 650. Third year, 850. Those are the data for year 2 and for project B. So let's cumulate them again. First year, nothing. That is 0. Second year, 650. Third year looks like 15. Is it? Yeah, 1.5. 1.5. So you can see this time we are recovering our 1 million between second and third year. That's where our initial investment lies. Initial cost lies there. 1M. So let's compute the payback period. So we can come and say here payback period. This is payback period is equals to 2 years plus. I told you get the balance. What's the balance? In the second year, you have only recovered 650. You need to recover 1 million. So you need another 350. Are you seeing it? You need another 350. So we add 350,000. I told you divide that by what? By the cash flow of the year of full recovery. You divide by the cash flow of the year of full recovery. That is how much? 850. Then I said you multiply that by 12. The reasoning was you need 350 in the other year, but it will generate 850. So if 850 will take me 12 months, how much or how many months would it take me to recover 350? That's what we are saying. So let me do that calculation. So this will be 2 years plus how many months? 2 years plus how many months? 350 divide by 850 times 12. Looks like 4.9 months. Let's just call it 5 months. 4.9 months is just like 5 months. Okay. That's all for year 2, our project B. Let's go to project C. We want to apply the same. Project C. I hope you are following. We come to project C. Again, we have the column for the year. Cash flows. Accumulated cash flows. Each project, 3 years, year 1, year 2, year 3. Let's go and copy the data for year 3, for project C, sorry. Let's go and copy data for project 3. Here, project C, I can see we are recovering 300,000 in the first year. Another how much? For project C, we are discussing project C, 300, 500 in year 2, and another 1 million in year 3. Let's cumulate them. First year 300, second year 500, that comes to 800. Then 1 million, it comes to 1.8. So we are recovering between, again, second year and third year. That's where our initial investment was, initial cost. 1 million. So we want to know it will take me 2 years and how many months? 2 years and how many months? So we come and say here payback period equals to 2 years plus. Get the balance. I've already mentioned how to get it. We don't need to explain again. If my initial cost is 1 million and by end of year 2, I've only recovered 800. I need another balance of 200. So we said you add 200, divide that by the cash flow of the year in full recovery, which is 1 million times 12. Because I've given you the reasoning, I need only 200 in the third year. But in the third year, I'm going to recover 1 million. So if 1 million will take me 12 months to recover, how many months will it take me to recover 200 only? That's what we are trying to calculate in the second part of this equation. Good. This will be 2 years plus. Let me calculate the number of months. It is 200,000. I divide that by 1 million. Whatever I get, I multiply that by 12. That gives me 2.4. Let me just call it 2.4 months. Or just call it 2 months. Okay, good. So that is the project recovery for our project C. Take me 2 years and 2 months, 2.4 months. Okay, let's now go to project D. Project D. We want to rank the projects according to the payback period. So let's repeat the same. So we again start with the column for the year, a column of the cash flows, a column of accumulated cash. This is accumulated cash flows. Year 1, year 2, year 3. We go and pick the cash flows for project D. Go and pick the cash flows for project D. Are you seeing them there? Yes. Project D will give me 800 in year 1, 400 in year 2, another 400 in year 3. So let's copy those ones. Year 1, 800. Year 2, another 400. Year 3, another 400. Good. Let's now go and calculate the cumulative. By end of year 1, cumulative will be 800. By end of year 2, it will be 1.2. And by end of year 3, it will be 1.6. So our initial cost lies between year 1 and year 2. The initial cost was $1 million. So that will be somewhere, that is where it lies. Somewhere here. Initial cost. Good. Let's compute the payback period. It will be 1 year plus the balance. I need to recover $1 million. By end of year 1, I've only recovered 800. I need another 200. I add that balance of 200. Then I ask myself, in the second year, we shall recover how much? 400. So I'm arguing by saying, if 400 takes me 12 months to recover, how many months will it take me to recover 200? So I multiply that by 12. That's what we are trying to do. So this will be 1 year plus. This looks like exactly half. It's 200 divided by 400, that's a half. That comes to 6, that is 6 months. Now we can do the ranking. Of course, you are starting with the project you will invest in first. Good. You can even write down there, the shorter the period, you can write down there, shorter the period, the better the project. Just to remind yourself, we want to rank our projects depending on according to their period of recovery, how long it will take them. So we have said the shorter the period, the better the project. So we start with project what? Which one takes the shortest? Project A was taking us how long? I think 2 years. Yeah. Project A took us 2 years. Yeah. Project B took me 2 years and 5 months. Project C will take me 2 years and 2.4 months. and project C at D, sorry, it will take me 1 and 6 months. So we start with project D. Projects start with D. After D, you go to which one? The remaining are 2, 2, 2. I think the first one was better. Project A just took a flat of 2 years. Yes. So we go to project A after that. Then after that, we go to project, which one? The other one is 2.4. The other one is 5. So we go to project C. Go to project C now. And then finally we go to B, which was taking us the longest. B was taking me 2.5. I think so. Yeah, 2.5 months, 2.5 months. 2 months, 2 years and 5 months, sorry. 2 years and 5 months. Good. That is it for that question. We are through with part 1 of the question. I've said the second part wanted you to apply the payback. No, the NPV, the net present value method, which I'll discuss later. It's one of the discounting method, but we want to finish the non-discounting methods. Finish. I introduce another concept. Finish. I introduce a concept now. Okay. Listen to this now. Normally, listen, whenever you are evaluating projects, you should evaluate them according to their cash flows. Listen to this now. Whenever you're evaluating projects, you evaluate them according to the cash inflows that they are going to generate. But some questions do not give you, listen to this now, some questions do not give you the cash flows. What they give you is the profit of the project in year 1, year 2, year 3, and so on. Or the profit per annum is this. Meaning, the examiner may give you what we call profit before depreciation and tax. Okay? If he gives you, let us assume it's a project, listen carefully now, let us assume it's a project with uniform cash flows. Like the one I was saying, 5 million, 5 million, 5 million every year. But now the examiner does not give you that 5 million, 5 million, 5 million every year. He tells you this company will make a profit of 5 million every year, or whatever they give you. That is the profit before depreciation and tax. But we don't evaluate projects on the basis of their profit. We evaluate projects on the basis of their cash flows. So in the income statement, these guys made a profit before depreciation and tax of 5 million. Normally, they could give you that figure. They give you the profit before depreciation and tax. How do you determine, listen to this now, how do you determine the amount of the cash flows? To get the amount of the cash flows, listen, you will come and take the profit before depreciation and tax. We want to ask ourselves, listen, you made this profit here before depreciation and tax. Or let's put it this way. You made a profit. Let me even put it this way. We made a profit of 6 million. Profit before tax. 6 million. Listen to this now. We are trying to ask ourselves, if everything in this P&L account was by cash, what would have been the profit? If everything in the income statement was by cash, you know, in the P&L account, let me use a T form. We normally debit P&L account with all the expenses. We normally credit P&L account with all the revenues and the incomes. So when you take the revenues and you minus the incomes, you normally get what we call profit before tax. Now, Is this 6 million the profit we made in cash? The answer is no. It's not the profit in cash form. Why? Because there are some expenses you could have debited in your income statement. Now that you have done accounting, there are some expenses you could have debited in your P&L account which normally do not involve cash. Okay? That means it's just a bookkeeping entry that you made in the books. Like which one? Like depreciation is an uncash item. Okay? Depreciation is considered as an uncash item. So we want to ask ourselves, listen carefully now, if everything in the P&L account was by cash, what would have been this profit? So it's like we are trying to cancel the effect of that depreciation and others so that we try and get the true profit if everything was by cash. What would have been the true profit if everything was by cash? Maybe the profit would have been 5.5. So if that would be the profit that would have been if everything is by cash, then that 5.5 becomes the cash flow. So we want to convert our profits into cash flows. That's the point I'm trying to explain. That some examiners don't give you the cash flows for the project. Whether it's the project that is generating uniform cash flows or the projects that are generating uniform cash flows, you could be told, first year we made a profit of 5 million. Second year, a profit of 3 million. Fourth year, a profit of 8 million. That is an uniform cash flow. But they are giving you in terms of profit. But now we want to say, how do you convert that profit to become the true cash flows? That's what I want to talk about now. Listen. So where you are not given the cash flows and the examiner gives you the profit, then the profit the examiner gives you, we always take it to be. Question may be specific, that is the profit we are calling profit before depreciation and tax. So first now calculate the true profit. What you will do, you will less depreciation. Whichever method the question will tell you to use, compute depreciation. Whether you're reducing balance, straight line method, it doesn't matter. Whether you're reducing balance, straight line, use the method they are giving you. Minus. Get what we now call the profit before tax. Profit before tax. Listen, then you less tax. Tax rate could be 30%, whatever it is, you minus. Get the figure we are calling profit after tax. Now listen, once you get the profit after tax, that profit after tax, listen carefully now, has taken into account one of the non-cash items in the income statement by the name of what? Depreciation. What would have been the true profit if that depreciation was not there? So you add it back. Now, you come and add back that depreciation charge. You add it. Now you don't subtract. You add it back. That will give you the true profit if everything in the income statement was by cash. And that now is how you convert the profit before depreciation and tax into cash flows. Are you there? So I'm saying that this concept of capital budgeting relies on cash flows. But there could be questions that give you profits, which you need to convert them into cash flows. So if the question is one where the cash flows are not uniform, maybe they give you year one, this was the profit, year two, this was the profit, 4 million. Do the same for year one, year two, year three, year four, and so on. If it's uniform cash flows, where we were saying, take the initial cost, divide by the annual cash flow. So if the question tells you, every year we shall be making a profit of 5 million, 5 million, 5 million, then compute the cash flow per annum which is this way. You take the profit before depreciation and tax, you minus that depreciation, whatever the charge, get the profit before tax, you minus the tax, get the profit after tax. That is the normal income statement. But then because we added or we deducted, listen, because we deducted depreciation as an expense, which is an uncash item, then we are saying to get the true profit, if everything was by cash, then you add back depreciation. You add back depreciation. Are you there? Good. That will give you now the annual cash flow if the question is one where it was giving you a uniform cash flows. Okay? Good. Let's put down that concept. That's the one I wanted to explain. Then maybe next time we shall now apply some past paper questions to this kind of a concept where the examiner does not give you the cash flows, instead he gives you the profits. So let's put down this. Andika somewhere NB, note. Just below that, andika somewhere note. Note. Sema hivi, most budgeting cash flows, most of the budgeting cash flow, most of the capital budgeting, most of the capital budgeting techniques, most of the capital budgeting techniques will require the use of annual cash flows. Will require the use of annual cash flows. We'll stop. Continue. When the examiner does not give you the cash flows, continue. When the examiner does not give you the cash flows of a project, when the examiner does not give you the cash flows of a project, but instead gives you the profits, of the project, then you should calculate the cash flows. You should calculate the cash flows. Continue. Such cash flows will be taken to be the cash flows after tax. The cash flows after tax. It's the same as profit after tax. Remember, we are just bringing back depreciation just to remove the non-cash one. So such profits will be taken, or such cash flows will be taken to be the cash flows after tax. The cash flows after tax. Then say this: when given profit before depreciation and tax, when given profit before depreciation and tax, when given profit before depreciation and tax, put in bracket that P, B, D, and T, when given profit before depreciation and tax, then the cash flows should be determined as follows. The cash flows should be determined as follows. So let's put down that logic I was explaining. We'll put down the logic I was explaining now, where I've said to get the cash flows, to take the profit before depreciation. Before depreciation and tax, whatever it is that the examiner will give you, take the profit before depreciation and tax, then you less the normal depreciation. Ideally, you are computing the true profit first. Ideally, you are computing the true profit that the company made. You minus that depreciation. That will give you profit before tax. Then you less tax, whatever it is, given 30% of that, it be the amount. Then you get what we are calling profit after tax. That's a normal income statement. Then I've said, now that profit after tax has taken into account depreciation, we want to know the true profit after tax. If everything was by cash, you add back depreciation. Add back, so you can come and say add back depreciation. Since, put it that way, add back depreciation, since it is an uncash item. Since it is an uncash expense, call it that way. Since it is a non-cash expense, add it back, and you get now what we are calling the annual cash flows. Good. That's how you determine the annual cash flows if the examiner gives you profits instead of cash flows. Said projects are normally based on cash flows, not profits. You need to convert the profits into cash flows. Good. Maybe we can stop there for today. Pick it up from there next time. I'll do a small illustration here with this approach. Then again from there, we do a few past paper questions. Again, we do 1 or 2 past paper questions relating to this approach where you are not given. Don't forget, we are still discussing the payback period. But in that payback period question we have done, we were given the cash flows. But I've said some questions still could be payback period or payback method, but any other method. But you are not given cash flows. You need to get the cash flows. Okay? Good. So I've explained how we shall be getting the cash flows. Get the normal profit after tax. Get the normal profit after tax. Then you add back depreciation because it's an uncash item. Okay? Good. So before we close, let me just remind you what we have said. Before we close, let me remind you what I said. I said to you, if you have not subscribed, please subscribe to this YouTube channel. If you have not subscribed, please subscribe to my YouTube channel. Okay? By clicking that subscription button down there. Then I say, please click the like button. Like my video. By clicking the like button down there, you click that like button. Click it as you are watching and click that like button. Okay? Good. Then I also told you that if you have friends or people you know who would want to do online classes, tell them we have online classes for financial management of the intermediate level, financial reporting of the intermediate level, advanced financial reporting of the advanced level. We have financial accounting of the foundation level. That's what we said. And the one of ATD1 and ATD2. Then I told you that if they are not able to join the live classes, they can buy what we call what? Pre-recorded videos. They can buy what we call pre-recorded videos, where they get the videos for the whole syllabus. They watch them at their own free time, at their own pace. That's what we said. Okay? Then I said for more information, you can reach me on this number 0722 6588 0722 658875. That is it. So let's meet next time, where we shall now continue and do the more discussion on the topic. Otherwise, bye for now. See you next time. Bye for now.